Most traders enter the market learning one primary rule: the US dollar and gold move in opposite directions. This relationship exists because global gold is priced exclusively in US dollars. You cannot separate the value of the metal from the currency used to buy it. This pricing structure creates a mechanical reaction. When the dollar gains strength, gold becomes more expensive for any investor holding foreign currency. That rising cost barrier reduces demand, which forces the dollar-denominated price of gold lower. These assets also compete for the same capital. During periods of economic uncertainty, investors choose between the liquidity of the US dollar and the tangible value of gold. They are the two primary safe havens in the financial world. Because of this, the inverse correlation serves as a foundation for global central bank reserves and institutional risk management. For a trader, establishing this baseline is mandatory. The most significant market moves emerge in the specific moments when this fundamental rule is broken. Occasionally, the market deviates from the script. You might see a session where the dollar drops sharply, yet gold stays flat, refusing to capitalize on the currency's weakness. Untrained traders often attribute this disconnect to random market noise or manipulation. Without a framework, they view the price action as an unpredictable anomaly. Technically, this event is a DXY-Gold Divergence. This signals that the forces driving gold have become stronger than its relationship with the dollar. It identifies a localized imbalance where the usual trend is reaching exhaustion, providing a technical signal for a potential reversal. We are looking specifically for a classic divergence. This occurs at the outer edge of a trend and serves as a signal that the market is preparing to change direction. This chart shows the price of gold, or XAU-USD. To begin the analysis, you need a clean view of how the commodity is trending on its own. Step 2 involves adding the US dollar index. By using an overlay tool, you can see the DXY moving in the opposite direction of the gold price. The third step is to invert the DXY scale. Flipping the axis allows the two lines to move in unison as long as the inverse correlation is functioning normally. You are looking for a visual disconnect. A divergence is confirmed when the DXY line pushes to a new high, but the gold line stays buoyant, forming a higher low instead of following the dollar upward. This visual split identifies a localized area where gold is resisting the downward pressure of the dollar. It identifies a point where the current momentum has reached an extreme. However, not every breakdown in this correlation is a trade setup. You must distinguish between a short-term divergence and a regime shift. A regime shift occurs when broad macroeconomic events, such as a major change in central bank policy, cause the dollar and gold to trend in the same direction for weeks or months. This specific playbook is not designed for those long-term trends. It is built for sharp, localized breakdowns found at clear swing highs or lows. Confusing a long-term macro shift for a short-term reversal can leave a trader positioned against a trend that has no immediate intention of stopping. Identifying the divergence is only the first step. It serves as an alert, but it is not a signal to execute a trade. To enter the market, we look for confirmation on the XAU-USD chart. This diagram shows a bullish pin bar forming exactly where the divergence was spotted. Another option is a break of structure, entering after the price completes a successful retest of new support. To strengthen the setup, traders often look for confluence. If the Relative Strength Index, or RSI, also shows a divergence, it provides a second layer of technical confirmation. Combining the macro context of the dollar with specific technical triggers allows a trader to filter out false signals and identify higher probability entries. Risk management parameters must be calculated and defined before a trade order is ever submitted. The most logical location for a stop loss is immediately below the swing low that formed the divergence. This exit point protects your capital. Take profit targets should be set at major historical resistance levels, aiming for at least a 1-to-2 risk-to-reward ratio. Capturing these efficiencies requires precise execution. This is why institutional participants prioritize low-latency environments and raw spread pricing to ensure their orders are filled at the exact target levels. Mastering the DXY-Gold Divergence changes how you view price action. You move from reacting to the market to proactively identifying the specific anomalies that signal the start of a new trend.